This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. We've got Salih Yilmaz from Dubai joining us today on the line. We've also got Patricio Alvarez here in London and Fernando Valle over in New York. Going to be a great discussion. I think we should start with the very recent conference that you've been at, Salih, for the last few days. You've been attending the ADIPEC conference in Abu Dhabi. I've heard there's been a lot of discussion on sort of three main pillars around energy security, energy affordability, and energy sustainability. Break down the tone of the conversation you've been hearing. Tell us some of your takeaways, please.
Sure. Thank you, Rob. So yeah, it was great to be at ADIPEC again this week. And I mean, it was very crowded, actually, more crowded than last year. I was lucky enough to be there last year as well. Obviously, we had a lot more COVID restrictions last year. And the one striking difference to me was the trilemma in energy that you mentioned. This is something that we heard last year as well, but the order seems to have changed. Last year, there was a lot of discussion about sustainability, and when we were talking about these three pillars, there was a lot more discussion around sustainability, and that seemed to have been the priority. Even though many speakers were still talking about the importance of energy security, it wasn't the emphasis like it is this year. And this was the biggest difference for me because now, as you put it, now the order seems to be energy security first, affordability second, and sustainability comes after that. So with that in mind, one other major theme that we kept hearing session after session was the chronic underinvestment in the sector. I mean, it's not the first time that we're hearing this, but this really was the major theme, especially on the first day. And I mean, obviously, this is partly due to the oil sector downturns, partly due to the pandemic. But we did have multiple speakers very passionately and explicitly saying that it was the policies around trying to end financing on hydrocarbon projects that essentially eventually led to underinvestment, and a lot of talk about how the ESG and the climate push may just have been premature. So again, I mean, this is I suppose not entirely new, but we just heard it a lot more this year at ADIPEC than we did in the previous years. So those were the very interesting things. And again, last year as well, this was very, very close to the COP meeting, and it is again this year. We have COP next week, so it will be very interesting to see what the tone is like at COP next week as well.
Almost no surprise that at an oil-focused conference, you hear this rivalry that's really emerged between the traditional fossil fuel business and all of the emergent new energy technologies. But I want to come over to you, Fernando, to really hit on the idea of chronic underinvestment. Is this something that you're seeing? You look after both Exxon and Chevron and some of the other big players in the Americas. Give us your sense. Has there been chronic underinvestment? Are we ceding market share to OPEC? How do you read the tea leaves?
Yeah, absolutely. I think it's been massive underinvestment from 2014, and while there's certainly something to be said about the pressures from ESG and the lack of financing from certain areas, it's also the industry's own doing. We've cut that back on exploration after 2015, which was the first real oil price shock. And we focus everything on shale. Shale was supposed to be the growth engine for the world. And what we're seeing is that it just isn't sustainable. The tier one acreage has largely been drilled for most. Their cost structure is rising because of chronic shortages throughout the economy. But then more importantly, the geology is just not there. When you look outside of shale, what resources do you have to grow? You know, Brazil is a big one, Guyana is a big one, but outside of that, we really haven't made significant oil discoveries. I think we're going to revert into having to invest again. That may be faster growth in Brazil. We can talk later about how the political changes there will affect that. But I think we'll need other areas from Western Africa to even Eastern Africa and potentially Gulf of Mexico, even oil sands. I think at today's prices, they're competitive for new builds, provided you can get the egress.
I want to build on this idea of chronic underinvestment because I think the clean energy crowd, the climate-focused crowd, Salih mentioned COP27, would say there's also been underinvestment in clean energy on the other side of the coin. So Patricio, let's bring you into the conversation. You look very closely at the European utilities and gas space. We're still in arguably the midst of dealing with Russia and how the gas balance is going to work out both this winter and next. How do you make the equation balance when you look at gas supplies into Europe, and what is the trade-off between increased gas supplies to meet energy needs versus some of the other options that are being talked about?
Sure. I think perhaps the most important part is to cover this winter or to make commentary on how well prepared Europe is to face the winter. So what brought us here and how well prepared are we? So storage levels are above the historical norm for this time of the year. They're on aggregate level, European storage is about 95% full, which is pretty much close to capacity. And this is on the back of the region's push to bring in more LNG imports and higher piped flows from Norway, which combined have made a really good job in replacing Russian gas cuts this year, with our analysis suggesting about 80% of the Russian gas losses have been replaced by LNG and Norwegian flows. So where does this put us? It's somewhat good news, but at the same time, let's not forget that Europe will need to cut gas demand this winter by about 15% in order to prevent the over depletion of these storage levels that were so so costly to build. I think that's also important, that perhaps the gas price volatility that we've seen over the summer could be somewhat attributed to Europe's sort of focus on refilling storage levels, which is an impressive feat if you look at it. But now it's a matter of conserving demand during the winter in order to prevent the crisis from extending into next year. And why is that? So we've seen that Russian gas flows were suppressed during this year, but they definitely capitulated after Nord Stream 1, the indefinite halt of Nord Stream 1, which is a pipeline that usually carries around 30% of Russian gas imports into Europe. That was followed by a suspected sabotage of the pipeline, which also marks a structural shift in European gas supply. We believe, just because it means that there is very little hope of a recovery in Russian gas flows in the foreseeable future. So this means that next year, Europe will have to fill a bigger hole because it's a 1 year time frame in which we're only receiving around 20% of what we used to receive of Russian gas flows in 2021. So there's a bigger gap to fill. And on the flip side, LNG, we do believe that the increase of LNG that we saw this year may be sustained into next year, but there are downside risks especially if Asian demand picks up and again begins to draw their cargoes into China and the rest of Asia. It's in the context of very limited supply growth. So incremental supply LNG next year is going to be around 5%, based on our analysis. So this leaves a very tight outlook into 2023, and I think the fact that we're now talking about how cold will the winter be makes trying to forecast the weather just tells you how tight the market is and how uncertain price volatility may be into next year.
Fernando, I want to get your reaction. just on the oil side of the equation, we just heard Patricio tell us that, we have what appears to be pretty good level of inventories to get us through this winter potentially, although next year maybe has some more questions hanging over it. But on the oil side of the equation, it appears inventories keep dwindling. What do you make of that? What's the read across into pricing as you look into this winter and into 2023?
Yeah, absolutely. I think for one, it's important to also point out that, Patricio hit the nail on the head, but part of the reason Europe has been able to get to 95% inventory fill is that they've cut demand very aggressively, from smelters to concrete to refineries. And, bringing it to the crude side, we saw today another 5 million barrel decrease in the U.S. inventories, including the Strategic Petroleum Reserve. And that is even as we get less and less supply from Europe. So our exports are still going out. Europe is not buying as much of it anymore, but we're still pushing out more and more crude. And we can't seem to find a balance. And, it goes back to the point that we said that shale has really been underwhelming relative to what was expected. And then you add to that the OPEC Plus decision to cut back on allocation quotas throughout the member nations. And we still see a divergence there on the supply-demand balance. The question then turns back into the consequences of this austerity, this energy austerity that Europe will be forced to impose. Will that impact economic activity, not just in Europe, but will that have contagion into other parts of the world? Remember, China buys a lot from Germany. And even Russia just came out saying that they are not going to be able to maintain production into 2023 of crude and products because the sanctions are actually biting, and they don't have the cash to continue investing in their fields. So we see it as the short-term risk is recession, not just Europe, but especially China. But the longer term, we see that accentuating what's already a very dire supply-demand balance.
Okay, very interesting. Salih, I want to get your take on this. I imagine this was part of the discussion at ADIPEC this past week. We had the OPEC research organization put out their world oil outlook. I think they're among the more bullish on demand growth that Fernando was just talking about. A very different outlook in many ways to the one that IEA just put out the week prior. How is the discussion from your perch around that supply-demand balance? And are folks actually talking about the potential for a recession and to knock demand growth in the years ahead?
Sure. So what they released on the first day of ADIPEC was their World Oil Outlook, the WU report that they have. And this is the longer-term report that they release. They also have a short-term one, MOMR, the monthly report. But this is the one where they look out to all the way to 2045 and make some projections to 2045. And as you say, it's always very interesting to see how their outlook and how their numbers compare to IEA, to EIA. And generally, I would agree with you that OPEC seems to be the bullish, both in the short term and the long term. And with this one as well, I mean, their demand outlook looks to me extremely optimistic. I mean, they have demand not peaking and gradually increasing to 110 million, slightly above 110 million barrels per day by 2045. Again, I think, arguably you could say that they're talking their book, but it's still an interesting report to look at. But what they're saying and warning for is that the supply outlook remains quite bleak, both in the short and to midterm. And they see kind of U.S. tight oil being the one that has to ramp up to be able to balance the market. But as Fernando rightly mentioned, there are some challenges there. So with that kind of very positive and very optimistic demand outlook, and just so many uncertainties and kind of constraints on the supply side, I think what they're implying is essentially a multi-year deficit in the market. But I mean, they also say, going back to the previous discussion, they think that there needs to be $12.1 trillion of investment into the oil sector between now and 2045. Most of it needs to be in upstream, but some of it needs to be in downstream and midstream as well. And in terms of downstream, I think this is very similar in most of these agencies. They do have refinery capacity additions coming, especially in the Middle East, Asia, and Africa. But even with that, they see at least in the next few years, tightness pursuing in the refining space.
Fernando, let's get your perspective. Where do you think that potential investment that is needed will occur? You gave a shout out to Brazil. I know you've got a note out on the recent political change there. Is that one of the countries that you think could potentially be a bright spot for oil supply over the next decade?
Yes and no. I think resource-wise, absolutely. And it's been, outside of U.S. shale and OPEC, the main growth driver in global oil supply. And there are a lot of resources still to be developed in Brazilian pre-salt. And over the past 8 to 8 years, there's been changes in the regulations that have allowed for faster exploration. Now, under Lula in his first 2 terms as president, he slowed down development significantly. He wanted to be a little bit more nationalistic with how oil was developed. So Petrobras was the sole operator of the pre-salt. Laws which were changed to make it so, and they had to own at least 30% of any fields that were developed from that point on. And they also stopped bid rounds for about 6 years. So if that comes back, it could be a big roadblock for Petrobras and for oil supply growth. Another point that he's made is that he wants to build refineries. And that's a big divergence from Petrobras's recent strategy. They tried building refineries back in between 2005 and 2012. They spent about $40 billion. They built half of a refinery, 115,000 barrels a day, so not very successful. So hopefully that is not a repeat over the next several years. Again, that really crippled Petrobras's ability to invest in pre-salt. With that said, I think Chevron spoke about the Gulf of Mexico being another area that could grow. Exxon has had a lot of exploration success in Guyana, so that's something that will come back. And then really, I think the next is up for grabs. Salih can tell you about ADNOC and Aramco both trying to grow capacity. How much they can grow remains to be seen. But I would think Western Africa, Angola, Ghana, used to be areas of great interest in the early 2010s. That's quelled after the first oil price shock. And again, I think Canadian oil sands are very interesting. They are actually much cleaner than people give it credit for, because there's a lot of mitigation now, and it is a very factory-like development. And their costs have come down significantly and can continue to come down if solvent-assisted technology is deployed. The big question there is, how do you get that oil out? Because Keystone XL is not moving forward. Trans Mountain Express continues to be a huge face huge hurdles in British Columbia. So if that can get solved, I think that can be an area of growth. Remember, it's the largest reserves if you don't take into account Venezuela's not so trustworthy estimates.
The saga around the Keystone Pipeline keeps me up at night. I can't believe that, 10 years ago, I feel like that the conventional wisdom was that it was a slam dunk, would be done in no time. And here we are kind of still talking about what its legacy could have been. Salih, I want to come back to you and get your reaction to what Fernando said on both Saudi Aramco and the other state oil companies in the Middle East. What's your sense? Are they prepared to increase output over the medium and long term? What type of investment level is required to do that? And I would note that I saw on the news that there is a new partnership that got announced between the U.S. and the UAE about accelerating clean energy deployment. So it wasn't even oil focused. And I think the thinking there is that if you look at wind and solar additions, almost 90% of the investment occurs in 10 countries. I mean, it's very concentrated. So maybe the idea is that you spread that around a little bit, but at least at the policy level, the conversation wasn't so much about oil supply and about the clean stuff. What do you make of that, and where are the national oil companies at?
Yeah, so the first part of your question, both ADNOC and Aramco are actually fully committed, and they, I think, see this opportunity for them to grab some extra market share, and obviously their balance sheet can allow them to increase spending. When we look at Aramco, their Capex last year was at $35 billion. This year, the guidance range is $40 to $50 billion. So they're aggressively increasing their spending, and they did say that their plan is to increase their maximum sustainable production capacity from the current 12 million barrels per day to 13. As Fernando said, I mean, how quickly they can do that, how successfully can they do that, and when they say 13, is it actually 13? We don't know, but obviously, I suppose in contrast to many, especially European majors, we know that the majority of their spending is still going to the legacy oil business, as they seem to be fully committed still to increasing their output. And as I said, I think as the rest of the world, pretty much the rest of the world, starts to shift their spending into other technologies, other businesses like low carbon businesses in the case of many of the European majors. And because their outlook, in line with the OPEC outlook that we see, because they have such an optimistic outlook for demand, for oil demand still, they see this as an opportunity for them. But in terms of how much they can increase capacity, in the case of Aramco, it's about 1 million barrels per day in total. That will be in different stages, but I think by 2027, they are planning to have added 1 million barrels per day of extra capacity. The UAE has a very similar kind of timeline, and they do also want to increase by a similar amount. So in total, there could be an additional 2 million barrels per day of additional capacity there. I mean, will that be enough to fill in whatever shortfall we might have? Because again, like on the other side, Russia, I think we're very much focused on the disruption risk in the near term, how many barrels that we're going to lose. But we shouldn't forget that beyond the very near term, there is significant risk that as some of the Western majors left the country because of the sanctions, because of the lack of kind of proper servicing in current fields, I think there is risk that we get further declines in Russian oil production as well. And on the second part of your question, the ADNOC kind of green spending and the cooperation that they're probably going to have with the U.S. I mean, yes, in the region, especially on the solar side, there is a huge potential, right? It may not be tapped as much as you would have thought, but I think there is huge potential. They seem to be increasingly interested in these type of projects. And on the solar side, I mean, I can tell you from experience now that I'm here for longer than a month, I mean, sunshine is plenty here. It's predictable, and they have a lot of land that they can use for that. And in terms of wind as well, perhaps not exactly here, but when you look at Saudi Arabia and the NEOM project that they are planning where this project is on the Red Sea. Apparently, it can get quite windy. So I think with especially the green hydrogen projects that they have, I think part of that is supposed to be powered by wind that they're planning as part of that green hydrogen project.
Very interesting observation, Salih. I'm glad you've noticed that it's sunny in your new part of the world. Okay, Patricio, I want to build on that and come over to you to just get some sense for the European gas companies and utilities. What do their Capex plans look like over the next 5 to 10 years? And are you worried that cash flows aren't going to be sufficient to fund Capex? And I guess that to sort of follow on is just, what about all this windfall tax stuff? Is that going to harm the ability of the industry to invest sufficiently?
Okay, let's unpack that piece by piece, I think. So first, the gas utilities that we cover are mostly retailers, so just gas retailers with little upstream exposure and regulated network operators. And this segment, I think, of utilities in Europe face a somewhat unclear outlook in the long term, just because, according to the Repower EU plan, natural gas demand in Europe will decline by more than 30% by 2030. So there's very little justification for these companies to invest in new gas infrastructure. Although there is opportunity perhaps in green hydrogen, we do see it tilt towards opportunities for growth in green hydrogen. But I think the early stage of regulation just conflicts with sort of materializing those plans further. There is opportunity there, but it's still somewhat unclear. On the other hand, we have the integrated and power utilities in Europe, and these are sort of the international big companies that have a global presence, have a strong renewable footprint in the US, the UK. They're just all over the West, really, not so much in Asia, but their Capex remains focused on renewables. Roughly 45% of their 5-year Capex plans are focused on the deployment of new wind and solar. And with the other half, or the other 45% or so, being focused on renovating and improving the resilience of their existing grids and networks. So we see that as the preferred sort of strategy of having a source of stable cash flows via the network part of things. It gives you diversification, stable cash flows, whilst the sort of more capital-intensive renewable arm continues to grow. And I think that's a good segue to explain how the current interest rate situation is affecting utilities. So in essence, on average, all European utilities are not free cash flow positive. These are companies that are heavily investing in technologies that have not yet reached the scale to justify their returns. So at this point, it's not looking great for some of the utilities because interest rates are going up sharply, and a few of the utilities, especially those that have a significant proportion of floating debt, are facing constraints in terms of renewing or reissuing, refinancing their debt, and we do see a risk of more capital increases, equity increases to sort of plug the gap. Although we do see a firm commitment to sort of extend that renewable focused Capex deployment, that we don't see that slowing, but we do see risks in terms of equity increases and perhaps a slowdown in dividends. So those are sort of the two key headwinds. But longer term, these are the companies that will remain, we believe, at the forefront of the energy transition. We've seen some of the European majors step up their investments in the U.S. On the back of the policy support with the Inflation Reduction Act, which is viewed as a very favorable supportive backdrop to grow their plans in the U.S. And again, it helps them diversify away from Europe, where the situation is still a bit dicey, I'd say, because producers here, utilities here have suffered, especially on the retail side, because they are not allowed to pass on higher wholesale costs onto their customers. So you see utilities that are more diversified away from Europe doing better at the moment, but we do see that continued focus on the renewable front for sure.
What an amazing turn of the narrative. I'm just struck by the idea that some of these companies are struggling with cash flow right now. You used to think of utilities as the sort of ultimate grandmother stock, stable, but that's just not the world we live in today. Fernando, for last comment, I want to come over to you and get your take, because I know your companies, many of them are reporting record earnings, record cash flows, these kinds of things, and that's kicked up the discussion about windfall taxes in the U.S. I think it's mostly rhetoric, but you tell us what's going on there with the windfall tax discussion.
Yeah, I agree with you. I think it's mostly rhetoric, and we have the midterm elections on November 8th, so it's just under a week away. It'll be very difficult to get that through Congress. Changes in the tax code are notoriously difficult, and certainly as we get into an election period. It also just doesn't jive with, it doesn't make sense, right? The administration always talked about how they wanted to reduce fossil fuel investments, and they got their wish. And now they're like, well, we need more. If you want more investment, the way to do it is to give regulatory clarity and allow these companies to put some money into the ground to raise production, not by increasing taxes, and which, for Europeans, I know this is not a concept that's clear, but it's un-American, as I've learned since I've lived here, to say you can't make profits. And so I think they'll have a really hard time getting that through.
Can I just get a quick sense? We'll do a round robin here, but Fernando, what are the Exxons and Chevrons of the world doing with their cash? How are they deploying it? Buybacks, dividends, more investment? What are they spending on right now?
All of the above. They're making way too much money, and they are going to eclipse their buyback plans. Their net cash, I think they could both be net cash by early 2023. So I expect them to see greater investments starting in 2023. It was already higher in 2022, but I expect another leg up in 2023 as they look to diversify their exposure.
Salih, let's come over to you. Same question. How's the Saudi Aramcos of this world spending their cash?
Sure. So I think Aramco is an exception. I'll come to it. But most of the European oil majors, what they're doing right now is because they are generating a lot of free cash at the moment, so they're boosting their buybacks pretty much all across the space. They're increasing their dividends. In the case of OMV, for example, they haven't been doing buybacks, so their total yield has been lagging peers. But they didn't announce a buyback. What they announced is a special dividend. And another exception, as I said, is Aramco. I think they're actually keeping their dividend stable. It's a massive dividend. It's a $75 billion dividend annually. Most of it goes to the government anyway. But they say, we kept it the same during the downturn as well. We're keeping it the same now. It's more of a flat dividend, but they certainly have a lot of room. So perhaps a special dividend could be on the table. But the reason why they're not doing buybacks, perhaps, is what linked to what we were discussing earlier. For them, the priority was very much to increase spending, not waiting until next year. I agree with Fernando. I think most of these companies will have much bigger increases in their spending next year. But Aramco is just ramping up their spending already. And another one was deleveraging. For them, during the pandemic, their gearing ratio shot up to more than 20%, which was very, very new for Aramco. So they've been trying to get that down to their self-imposed range of 5 to 15%, and currently it's less than 7%. So that's what OMV and Aramco are doing. That's kind of different, but most of the other majors have been doing mainly just more buybacks and higher dividends.
Patricio, let's come to you. How are the youths and the gas companies spending their cash?
Yeah, so sort of echoing what I mentioned before, not a lot of free cash flow at the moment. These are very debt-heavy companies that will, we believe, remain committed to their renewable growth opportunities over capital shareholder distributions and capital distributions. I think that will be the focus. We do see scope for asset rotation, so to shed some assets in order to recycle that capital. We see that trend going on, and I think that will meet up somewhere in the middle with the oil majors' intent to capture a piece of the renewable growth pie. We see that perhaps happening into next year. And also thinking about the defensive nature of utilities, it seems like we're in a dicey patch right now, but we do believe that in a recessionary sort of environment, utilities once again will have a bit of a better appeal once we're on the better side of the European gas crisis.
Just quick commentary from me. I think the perception is that most of the wind and solar names are just simply torching cash. It's not true completely across the board. We saw from Vestas earlier today, very challenging quarter. They are running at an operating loss. And I think the sort of broad theme is that the wind names are struggling near term. A lot of that's because of the run up in steel prices. And we do see some turnaround in the years ahead, because if you're not paying attention to the steel side of the equation, there's been a big pullback over the last 6 months. Prices for steel down 55%, something like that. And on the solar side, you've got some names that are funding all of their growth with cash flow. A company like Enphase that makes inverters. So take a look at our analysis. Everything that we've been talking about here today, you can find on BI Go. If you've got a company ticker loaded on your terminal, just type BICO and you can read our company outlooks, including our analysis and commentary on the most recent earnings and all of these bigger long-term strategic topics we've been talking about as well. So thank you for your time today. Look forward to being in touch. If you got follow-up questions, just shoot any one of us on IB. We're easy to find. And I hope you have a great week. We'll talk to you again on the third Wednesday of the month. Take care, everyone.